We are now in the second video for the final chapter in intermediate accounting, so chapter 21. And in this chapter, we are talking about the statement of cash flows. So we talked about the different categories, the different elements of the statement of cash flows in the first video. And in this one, we are going to cover a lot of information and we are going to look at how to actually analyze what's going on with the balance sheet and the income statement, and then ultimately prepare the statement of cash flows. And we're going to take that into consideration with the direct method and the indirect method. So you got to hold tight because this is not going to be the easiest content, nor has a lot of what we've covered been, but you're at the end and we can get through this. Okay, so the first thing we need when we do this is the income statement. We need that for the current year, the one that we're trying to create the statement of cash flows for. Then we need the balance sheet for the current year and the previous year. We will also need some additional information that is not necessarily reflected on those two statements to make sure that we understand fully what is going on with the cash throughout that year. So I am going to show you a balance sheet, comparative balance sheet for 2026. We're preparing the statement of cash flows for 2026, and it's going to be for 2025 so we can compare the two. I highly recommend that you at least take a picture or a screenshot or maybe print out a screenshot of this. In fact, I did that. This is what I used when I was creating all of these slides. So I created this balance sheet. Then I printed out a screenshot of it. So we'll have that. And we're also going to have, and I'll go back to that balance sheet, but we're also going to have the income statement. And I did the same thing. I took a screenshot of it and I printed it out. So I highly recommend that for you. So let's go back to the balance sheet real quick and just kind of look at what's going on here. But I'm going to reference back to it over and over and over again. In fact, I'm going to lay these sheets in front of me so that when I reference them, I can see it. So please find a way that you'll be able to reference back to these slides as well. So you see everything from all of our assets, our cash, everything that's happened with each of our assets, each of our liabilities, and each of our equity accounts. We can see those reflected here. That's going to be really important because just starting out, we see that cash went up by $22,000 from 2025 to 2026. That's very important for us to understand. We see that accounts receivable went up by $2,000. We see that short-term investments went up. It didn't even exist in 2025, so it went up to $15,000 in 2026. You're going to see everything from accumulated depreciation. So we see a decrease in accumulated depreciation. So why would that be? So we're going to look at why that is. Then we look at our different liabilities. We didn't even have notes payable in 2025, but now we have it in 2026. We see everything from our discount on bonds payable decreasing by $2,000. And then we even see differences in common stock and retained earnings. So what we're going to do is we are going to look at each of these accounts and how they've changed from one year to the next and think about how would this have affected cash. Then we're going to jump over to our income statement. Well, actually, we're going to be working with all this simultaneously, honestly. And we're going to say, okay, so we have sales revenue of $111,000. Did we get all of that in cash? And we're going to talk about how to consider that. We see investment revenue. Did that actually come in cash? Gain on the sale of land, cost of goods sold, all of these things. How would these have actually affected cash? And then we will also be referencing that additional information. So a lot going on here. Very crucial for you to have these two slides printed out or on separate screens or at least on your phone while we're talking through it, because this is going to be a puzzle. And I want you to think of it as, something fun. It's a puzzle that you're going to be looking at all these different things. You're like a detective. I mean, seriously, I'm not just trying to make it a game. You really are like a detective when you're creating the statement of cash flows. You say, okay, sure, we have 111,000 in sales revenue, but what other clues could I put together to figure out whether that actually came in cash or whether it's still owed to us? So we are going to go back and forth for each of our revenue and expense accounts, each of our balance sheet accounts, and we're going to be considering all of this additional information in there as well. So let's jump in. Okay, time to connect those puzzle pieces. So first, we're going to think about our sales revenue. So we see that it's 111,000 as sales revenue, but let's think about what else would have been affected to show us whether or not that 111,000 came in cash. And so we say, what balance sheet account would have been affected? It would have been accounts receivable. Okay, so accounts receivable has to do with our credit sales, how many people owe us, and how many people have already paid us. So if we look at the asset section of accounts receivable, you see that we started with $20,000. So I reflected that here in the T chart. We've got a beginning balance of 20,000. And we have an ending balance. We had the ending of 2026. So I'm saying beginning balance. So the end of 2025 was 20,000, which would be the beginning of 2026. The end of 2026 was 22,000. Well, if all of those sales were credit sales, then we would have had all of those debited to accounts receivable. Well, if we started with 20,000, we added 111,000, then we have 131,000. Then at the end, we only had 22,000 left. The 131,000, the total amount in accounts receivable minus the 22 that's still in there would give us 109,000 of cash received. Okay, so if we were doing the direct method, and we talked about the indirect and direct method a little bit in the last video, and we're going to talk about it more in the third video for this chapter. In this video, we are focused on each of these transactions and putting the puzzle pieces together. So we see that it was 109,000 cash received. So if we did the direct method, that's what we would put on there. There was 109,000 in cash received. If we're doing the indirect method, we need to say, okay, we had net income of this much. How did this net income, how much of this was cash, how much of it was not cash? So now let's look at what journal entry would have been made for all of these entries throughout the year. So every one of these, we're going to look at a journal entry. It doesn't mean we have to make a journal entry at the end. We don't have to make a journal entry at the end. They've already been made. We already showed our accounts receivable increasing and decreasing as customers were buying and paying. But let's just make a cumulative journal entry to show what actually happened in these accounts throughout the year. So here we go. We know we had cash come in of 109,000. We just calculated that here. Our accounts receivable ultimately increased by $2,000, right? Beginning balance 20,000, ending balance 22,000. So our accounts receivable ultimately increased by $2,000. And we also know our sales revenue was 111,000. These balance debit and credit, so we're good with that. And if we were making the indirect method statement of cash flows, then we would have started with our net income, which, as you can see on your income statement, was 27,000. And we would say, wait a second, 2,000 of that is still sitting in accounts receivable, because accounts receivable went up by $2,000 from one year to the next. So 2,000 of that we have not gotten in cash yet. So when that's the case, we would be taking out that accounts receivable for the indirect method. But we'll look at that more in the next video of how we put that statement together. And meanwhile, we're working with Fizz Freeze, which is our carbonated popsicles. So don't you like the little picture that AI made for me? I was like, put a popsicle coming out of a soda because it's a carbonated popsicle. I was pretty impressed. This was the first result it gave me. I was like, yes, I like it. Okay. So now let's move to investment revenue. We're just moving right down the line of our income statement. So we've got our carbonated popsicle company, and we see that there is investment revenue of $3,000 on our income statement. Well, we come to the conclusion that investment revenue must have been received in cash because there's no accounts receivable for investment revenue. If we had seen an accounts receivable pop up saying investment revenue receivable, then that would tell us, well, the company we invested in told us they're going to pay us, but they haven't yet. But nothing like that's popped up. So we must have gotten it in cash. So I'm assuming we had a debit to cash for $3,000 and a credit to investment revenue. So that one was easier. We didn't have as much going on, but we did have to look and make sure there was no account related to that. What's our next one on the income statement? We've got our gain on sale of land. Now this is tricky. You're like, oh, so is accounts receivable and sales revenue. I get it. The gain on the sale of land. Okay, so if we think about what happened here, we had a piece of land and we sold it for more than what the book value was, right? Anytime that there's a gain or a loss, it's because the book value was either more or less than the cash or whatever the asset we received. So with a gain, that means they must have received more in cash than the book value was. So what we're focused on right now at the beginning of this video is our operating activities. Now, while the gain on the sale of land shows up on our income statement, and we saw there was a gain because there was a difference between cash received for the sale and the of the asset and the book value of the assets. They received more cash than the book value. But one thing we have to remember is, like, this is what our entry would have looked like. We had cash come in of $17,000. And the reason we're getting that is if you look at the additional information, the very first additional information, it says company land purchased in a previous year for $10,000. Okay, so it would have been sitting on the balance sheet at $10,000, was sold for $17,000. Okay, so we got cash of $17,000, just like we see here, and we took the land off of the balance sheet for $10,000. Well, we got to have entries that balance, so we have $7,000 as a gain. The important thing and the tricky thing here is how that gain is treated. So what is the cash effect of the transaction? Well, we saw that. I'm going to go back to the last slide. The cash effect was $17,000 came in. Okay, so $17,000 came in. It was an inflow of cash. Anytime that we sell an asset, we sell a long-term investment asset like land or building or equipment, it shows up not under operating, but under investing activities. So that full $17,000 is going to show up under investing activities. So gains and losses that were related to that, they actually need to be ignored in the operating activities. So even though on the income statement it shows this gain of $7,000, we don't want to put that in the operating activities because all $17,000, whether there's a gain or a loss, all $17,000 coming in from the sale would be reflected in investing activities. The $7,000 gain, if we also put that in operating, then it would show it as if we had $24,000. We had $17,000 from our investing activity, and we show $7,000 from our gain. But no, let's leave it out completely out of the operating section. That way, we can show the whole thing in our investing activities. Whether there's a gain or a loss, all of that gets worked out in the investing activities because at some point we paid $10,000 cash for this. Now we've got $17,000 coming in. We automatically are going to be recognizing that $7,000 gain in the investing activities. Don't put it in the operating activities. And if we're talking about the indirect method, we actually need to take that net income number of $27,000 and we need to add the gain back in because that was not additional cash we got for operating. That's going to be shown later on in the investing activities. So when there's a gain or a loss for the direct method, don't put it in the operating activities at all. It'll be reflected in the investing activities. If you're doing the indirect method, you need to add back the gain or reduce it by the loss because we'll get to see that in the investing activities later. I know that's confusing. I know. I never look forward to explaining that because it's like, what are you saying? Maybe listen to that multiple times. Maybe stop and really think about it. But with each of these things, I'm going to walk you through each one, but you need to really understand each one, and that's going to take you sitting and thinking about each one. So maybe each of these transactions I'm talking about, maybe you pause the video, write it out, take a moment, make sure that you are fully grasping what I'm referring to, because it is something that is kind of sitting and meditating on each of these concepts, and you just have to understand what to actually do. It's not memorizing, it's understanding what's actually happening here, and that's what's really going to help you. Memorizing, maybe a little, but primarily it's going to be understanding how all these accounts connect. So we'll go down to the next item, under expenses, and we've got a single step income statement in this example. It could be the multi-step where we had cost of goods sold up there with revenue, and it doesn't matter, but we can do it in whichever order, it's fine. But since we have it this way, we've got cost of goods sold next. So how does that affect the balance sheet accounts? Well, that would have affected inventory, because cost of goods sold is when inventory is sold. And it would have affected accounts payable, because accounts payable is whether or not we've paid for the inventory yet. So we have the initial part of this is we have inventory come in and we owe on the accounts payable. Then when we sell it, it goes to cost of goods sold. Maybe we've paid for that inventory, or maybe we haven't even paid for it yet. Maybe we've already sold it, but we still need to pay the supplier just because it all happened so quick. So we look at our balance sheet and we say inventory started at 17, okay, at the end of 2025 or beginning of 2026 was 17. The ending was 13 in 2026. Then we look at cost of goods sold. Cost of goods sold is when inventory leaves, it is credited and it goes to cost of goods sold. So our cost of goods sold over on the income statement says 50,000. So we have to fill in how much did we actually purchase during this, and we would have purchased 46,000. We had the 50,000 we sold, we already had 17,000 in there, and we still have 13 left. Well, we must have purchased 46,000. Okay, so now we're going to plug that number in to accounts payable. Our beginning balance of accounts payable, we can see from our balance sheet, is 20,000. Our ending is 26,000. And we know from looking at inventory that we purchased 46,000. So now we can take the 20 plus the 46, we have 66, minus the 26 we still owe, and that means that we have 40,000 that we must have paid to our suppliers. So we went all the way from our cost of goods sold, had to work through inventory to ultimately get to accounts payable to see how much have we paid for of this inventory so far. So while we purchased 46,000 throughout this accounting period, we've only paid for 40,000. So the 40,000 is what we would show as a reduction or be a cash outflow in the direct method. Or we would look at it as, for the indirect method, hey, we haven't actually paid for all of this yet. So let's look at our journal entry for the cost of goods sold. While 50,000 was the cost of the popsicles sold during the year, only 40,000 in cash was paid to suppliers that same year. So we have cost of goods sold. We're not recording this. Remember, this is just us reflecting on what would have been the net amount recorded throughout the year. So we know from our income statement that we have 50,000 debit of cost of goods sold. We debit cost of goods sold just like we do any expense. We also know that inventory ultimately went down by 4,000. So we credit inventory by 4,000, the beginning balance minus the ending. And we know that accounts payable went up by 6,000. So that means our cash paid to the suppliers was only 40,000. So there was 10,000 there that was an expense for us, cost of goods sold, but we haven't actually paid for it yet. So if this was the indirect method, we would actually add back in that $10,000 difference, because we'd be showing cash has not gone out for that yet. And with the indirect method, it's all about taking net income and saying what pluses and minuses do we have to ultimately get to how much the cash was affected by this. All right, so you might want to pause it and kind of think through that, write it. And you know what I would do as well, and this is just me, but I would take these printouts and I would or maybe you've got on your phone, and I would mark through, okay, Check, I've done sales revenue. Check, I've done investment revenue. I would do it like that, but that's just me. So, all right. So now let's look at our salaries expense. We're just going right down the line. Salaries expense. So we see that the expense, first of all, let's see what it connects to. Salaries payable, right? So sure, that's an expense, but have we actually paid our employees all of that yet? So we go over to salaries payable on the liability section of the balance sheet, and we say it started at 12,000, it ended at 14. And we know our salaries expense from the income statement was 12,000. So our beginning balance plus the salaries expense that we added would give us 24,000 minus the 14,000 that we still owe the employees, means that there was 10,000 that we have not, or that we did pay to the employees. We still have 14 that we owe them, and we have 10,000 that we did pay in cash. So we just fill in that entry to show what has happened throughout the year. We're not actually recording any entries when we create the statement of cash flows. We're just reflecting on what had happened. So we debited salaries expense. We credit salaries payable for the difference between the beginning and ending balance. And then we are crediting cash for how much was paid out. Now that sounds a little bit confusing because you see a debit in cash here, but that's saying it went out of salaries payable, but the other side of that entry would have been it went out of cash with a credit. Okay, so now we're going to look at depreciation expense. So depreciation expense is unique because what is the effect on cash for depreciation? Well, let's look at what the entries would have been. So when we look at depreciation expense on our income statement, it was $4,000. So we would have recorded a debit of $4,000 and a credit to accumulated depreciation. Did this touch cash at all? No, there is no effect on cash when we record depreciation expense. Therefore, it does not have an effect on cash under the direct method. So the direct method, we would leave depreciation expense off completely. You would not list out depreciation expense on the direct method where we're listing out all of the individual items because it didn't have any cash go out. For the indirect method, we're starting with that 27,000 of net income, and it would actually be one of the first things that we would point out when it came to the indirect method, because we would be saying, hey, by the way, that depreciation for 4,000, we're going to add that back in because that did not show that there was no actual cash that left for that. So with the indirect method, we would show depreciation expense being added back to net income because there was no actual cash leaving. So that one's always an easy one that you can jump to in the indirect method to say, ooh, I know that one can be added back because there was no cash that was leaving our hands, no outflow. Okay, so now we get bond interest expense. This one's going to be extra tricky because now you got to rewind back to chapters 12 and 14 where we talked about bond interest expense and think about what's going on here. So bond interest expense, as you may or may not recall, is not the same amount of cash paid to the bondholders when the bonds are issued at a premium or a discount. So, okay, we see that bond interest expense was $6,000, but that doesn't mean that's how much cash was paid. The other thing we have to look at is under liabilities. It's the contra liability or adjunct liability if it were a premium. But under this case, it's an adjunct. I apologize. It's a contra liability because it is a discount. So we saw it went from 3,000 to 1,000. Okay, so we see bond interest expense on the income statement is $6,000. So that's what would have been our debit. But we know that the discount on bonds payable, the very bottom line under liabilities, it decreased by $2,000. So part of our bond interest expense was that decrease in bonds payable, which we call the amortization of a discount. So that would have been part of it. Then the difference would have been how much was actually paid in cash to the investors. So that $4,000 that was left over would have been the actual cash effect. All right, so our insurance expense. So what's also affected, not just the insurance expense, but on the balance sheet, it could be prepaid insurance. Because remember, a lot of times you have paid for insurance up front for maybe months or a year or multiple years. So we need to look and see, maybe some of that we've already paid out. Maybe all of it wasn't actually cash this year. So yes, indeed, that's exactly the case. If we go to the balance sheet and we look at prepaid insurance, which is an asset, it brings us value in the future. We started with 8,000. You see beginning balance 8,000. We ended with 4,000. Okay, so 4,000 of our $8,000 of insurance expense was actually paid back in 2025. So 4,000 of it should not even show up as cash. So not all insurance expense was paid in 2026 in that current period. Instead, part of it was paid back in 2025, and we're taking it out of prepaid insurance and expensing it out. So if we had beginning balance of 8, ending balance of 4, and then we show insurance expense on the income statement of 8, then we would have said, okay, only 4 was actually paid in cash. Otherwise, the rest of it we paid out. So the rest of it we had already paid into it, I apologize, in 2025. So this is what the entry would have ultimately looked like that would net out throughout 2025. Or through 2026, we would have debited insurance expense for 8,000 because that's what we see in the income statement. We would have credited the prepaid for 4,000. We see that when we look at the balance sheet that's comparative, it went down by 4,000. So the other 4,000 was all that we actually spent in cash. Okay. We already saw a gain on the sale of land. Now we're going to see a loss on the sale of equipment. So it tells us in our notes, in our additional information, equipment that originally cost $16,000 was sold for $5,000. And it was half of it, I can't talk, half of it was depreciated at that time. Okay, so we're going to find the book value. The book value is going to be the historical cost of the asset. So it cost us $16,000 minus any accumulated depreciation. Well, they said they depreciated 8,000 of it. So the book value is what's left over. We have 8,000 left over. They depreciated half of it, so we still have a book value of 8,000. Well, they only sold it for 5,000. So that $3,000 difference, we were valuing it at 8,000 on our balance sheet. Our buyer only valued it at 5,000. So we have a loss of 3,000. So in order to get this asset off the balance sheet, this is what we would have had to have done. We would have debited cash for the 5,000. That's what the customer, the buyer bought it for. Then we would have, even if we didn't know yet about the loss, we were still trying to figure it out, let's say, we would debit the accumulated depreciation for half of it, for the 8,000, to get it off the books because we've gotten rid of the asset now. It had a normal credit balance. We got to get this piece of equipment off the books, so we're going to debit accumulated depreciation. And then we would have credited, in this case, they grouped together building and equipment. We would have credited that for the full 16,000 whenever they sold it. Then we would have seen, oh, we're missing 3,000 in a debit. Anytime there's a debit, it's a loss, just like an expense is a debit. If it would have been a credit that we needed, it would have been a gain, just like revenue is a gain. So the sale is reflected, again, in investing activities. The loss should not show up on operating activities under the direct method. The indirect method, they would have actually added that back in because we didn't actually lose any money from this. It's not like we actually paid out cash. Instead, that loss is going to be netted out in the investing activities. So we really just go back to the same concept as the gain on the sale of land. We're getting close to the end here. We've got the end of our expense accounts anyway. So income tax expense. So this would be directly related with income tax payable because we are going to show the expense each month, but we don't actually pay the government, but probably every quarter. So it's going to be sitting in income tax payable. And we see on the balance sheet, comparatively speaking, the beginning balance was $7,000, the ending was $5,000. So we had, and then we had the expense itself of $11,000. So how much cash did we actually pay out? So if we took 7 plus 11, we'd have 18,000. That would be our total amount in income tax payable throughout the year. But we ended with just 5,000, so we paid out 13,000. So even though our income statement showed only 11,000 in expense, we paid out even more than that in cash because we still owed some from the prior year. So our cash effect would be our 13,000 leaving. So that's how much we would show as an outflow of cash. And we'd have the income tax expense of the 11,000, but income tax payable went down. So they paid some of that payable from the prior year as well. Now let's jump over to the balance sheet accounts that we did not touch on whenever we looked at the income statement. So the first one is short-term investments. And if you were going through and you were checking off each one as we went through, you noticed short-term investments weren't touched. Well, short-term investments would be an investing activity. Where was our clue there? The word investments, right? It went from 20,000 to 22,000. So I'm sorry, it went from, I'm looking at the wrong line item. It went from 0 to 15,000, and we are not seeing anything different. So we are going to assume it was cash that was paid out for that. Then we have our land. Now we have touched on land when we had the gain on the sale of land, but that was only for our $10,000 that would have shown up on the balance sheet. But if you look at land, it actually went up by 12,000. Okay, so we had land of 40,000. We sold 10,000 of it, so that would give us 30,000 in land, right? But then it's up to 52,000, so we must have had an increase somewhere of 22,000. Well, if we look over at the additional information, we see land was purchased for $22,000 to be used for a parking lot. So it is reflected as an increase on the balance sheet. The balance sheet only went up by 12,000, but remember that 10,000 that we sold would have decreased it, so it nets out to an increase of 22,000. So we increased land by 22,000. And we decreased our cash by 22,000. So that would also show up in the investing activities. Now we want to look at some non-cash investing and financing activities. So we see over in the additional information that new equipment was acquired by issuing a 6% 5-year 22,000 note payable. Okay, so the new equipment makes popsicles, and I had AI create this popsicle making machine. Don't you love it? I was really excited. Sometimes you never know what you're going to get when you ask AI to create an image, and I really thought this one was good. So there's our popsicle creating machine. If you didn't know how popsicles were made, now you do. This is how our carbonated popsicles are made. So, okay, no cash exchange was exchanged here, but we see that we would have increased our equipment and we would have increased our note payable. So this is one of those non-cash, we talked about that in the last video, non-cash investing and financing activity that we have to include a note about that on the statement of cash flows because it does affect investing and financing, even though there's no cash that's affected quite yet. So that would account for why land went up by a total of 12,000, but 10,000 of that was the sale of land. So then the 22,000 increase of land of building and equipment would have been from this. All right. Our bonds payable. Another great image from AI, except it never wants to give me exactly what I want when they're spelling. I'm sure you've noticed that. So Fizz has an extra Z in it, and yeah, we'll just ignore that. I still thought it was cute. Okay, so the financing activity here, we have $9,000 of bonds that were retired at maturity, meaning that we, Fizz Freeze, paid this bond. So we would have had cash going out for that. So we got rid of our bonds payable. Awesome. We don't owe them anymore. But we also got rid of some of our cash by doing that. Then we look at common stock, and we're just going through the additional information and looking at the comparative balance sheet with each of these. So a financing activity, anytime that we issue new common stock or we pay back owners, that's a financing activity because it's a way that we got money, right? Not through normal business operations. So common stock increased due to a sale of 5,000 shares of common stock. The market price and par value were the same, made it a little easy, for $5 per share on the date of the transaction, and that is letter G under additional information. So if we have 5,000 shares times $5 each, we increased cash under financing activities, and we also increased our common stock by 25,000, which you see reflected in the comparative balance sheet. Last one we're going to look at in this video, and then we're going to look at kind of putting all of it together. So you definitely want to watch the next video as well so you can see where all of this goes. But we see in H that we had cash dividends. So it says that this is also a financing activity. If we pay dividends, it's a financing activity. So cash dividends of 5,000 were paid to shareholders. So we know when we pay out dividends, we decrease retained earnings with a debit, and we are crediting cash. And that makes total sense because if you look at the comparative balance sheet, they had 37,000 in retained earnings at the end of 2025, and it jumped up to 59,000. But that was only a $22,000 difference. Our net income was 27,000. So it should have gone up by 27,000, and it did, but then they gave away 5,000 as dividends. So that's where that big difference came in. All right, you might have to watch that video a couple times. I know it's really overwhelming. It's a lot of information, but I hope that you will take time to really understand each of the concepts and then jump into the third and final video as we put all of this information together.